As soon as the details of Joseph Biden's proposal to suspend the federal fuel tax became known, trading activity in the energy market increased. In just a couple of hours, oil prices jumped to $112 from $108, but then quickly dropped to $110 per barrel. The point is that the plan presented by the President of the United States seems rather weird. Biden calls for a 3-month tax holiday. However, this measure is unlikely to have the desired impact on inflation in such a short period of time. Moreover, oil consumption will hardly rise significantly. Summer is a holiday season in the United States, while fuel consumption traditionally increases thanks to trips around the country. Thus, market participants cannot understand what kind of effect this measure will have. However, this initiative has not yet been taken. Moreover, Congress has not yet set a date for its consideration. Until then, the market situation is expected to remain uncertain, which equates drifting around the current values. According to the trading chart, Brent crude oil futures continue to trade downwards as a part of a corrective move, although the asset is falling deeper into oversold territory in the short term. Sellers have every chance of dragging the quote further down towards the level of $100 per barrel. Meanwhile, gold prices soared by almost $20 per troy ounce, but this did not lead to a drastic change in the market sentiment. The yellow metal entered a slight pullback, which is quite logical in the event of such a rapid movement. The asset is still trading under pressure, which is confirmed by a ladder-shaped downtrend pattern. If the price returns below the 1,825 mark, it will most likely extend losses and break through the support level of $1,800. Alternatively, gold may start drifting around the 1,840 mark. Such a steep rise can be attributed to the risks of a hard landing voiced by Fed Chair Jerome Powell. This refers to sharp and deep recession, which may well turn into a protracted crisis. According to Powell, achieving a soft landing will be very challenging, although the head of the central bank did not frankly state his concerns about a recession. He made it clear that such a scenario is inevitable. Against this background, investors decided to flee to safe haven assets, including gold. However, the gradual tightening of monetary policy by the US Federal Reserve, as well as the upcoming interest rate hikes by the European Central Bank, will continue to widen gold. Thus, its growth is likely to be short-lived. Speaking of the Russian currency, it resumed its bullish run following protracted stagnation. Yesterday, the dollar-ruble pair fell below the level of 52 rubles per dollar again. The Russian ruble spent the last 2 days confidently, staying below 54 rubles per dollar. This is well below the values posted last week. As long as the Bank of Russia keeps its key rate at a relatively high level and various restrictive measures introduced in response to Western sanctions remain in effect, the ruble is expected to keep edging higher despite government official statements about an economically sound exchange rate of 80 rubles per dollar. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.